the week ahead. Start off by viewing the monthly bar. As you can see, the monthly bar is one time framing lower. When a monthly bar is one time framing lower, that is an indication that a meaningful correction is underway. These markets have been very difficult. We have decided to offer you a webinar on Sunday morning. It will be 11 a.m. Eastern time. It will last probably about 45 minutes. The registration is below if you would like to join us. And like all of our webinars, it will be recorded. On the surface, the commentators will tell you that the current break is different because it is man-made. I don't listen to that. I will tell you that this break or correction has been building for months. If you take a look at the weekly bar, and it's a little different than the weekly bar we've been showing, but the weekly bar shows that the market has been moving sideways for a considerable period of time in forming a balance. It is not uncommon, once the market forms a balance, particularly after it has been rising, for the market to require a catalyst to trigger the second stage from a market that moves sideways, which would be a change in direction. In this case, the change in direction is clearly down. The catalyst that triggered this is the tariffs. Once the break is underway, the market needs to establish a new balance or trading range. Currently, there is no sign of balance developing. As you remember, if you've been with us for any period of time, markets transition from trend to balance and back to the original trend, or from balance then to trend continuation. So the next thing we're really looking for is for the market to start to find some types of short-term balance. For right now, the trend is down. We need to find short-term balance in order to bring the market back into a more tradable visual representation of the market. Many got excited following the initial break a couple of weeks ago, and they were talking about this was a tradable rally. Wes, the market did go on both breaks. The market went from the low back to the high, but those rallies were not tradable rallies, really. They were short covering rallies. Market inventory got too short, and as we've talked so many times, inventory gets too short, that will give you short-term strength to the market. Once that short-term strength is removed following a short covering rally, the market very often goes back to show its true form. Following the initial break, commentators would tell us that, that this was healthy and the market was fairly priced now. I really don't think that was a correct view. The PE was approximately 21. Just for perspective, a more typical PE, for a market that was, fairly priced again, would probably be more around 16 or 17. Now, I haven't looked what the PE is following Friday's break, but it would be something to keep in mind. The odds of recession have risen substantially. Some place these odds around 60%. Recession is not something that we welcome as long-term investors. They're okay for traders because it will provide some trading opportunities, but it's not what you want for long-term. On top of a possible recession, stagflation appears to be high. I have talked before that stagflation occurs when the inflation numbers remain stubborn, which is more than likely to happen with the tariffs, and growth or job creation remains stagnant to even slower. Volatility is exceptionally high with short-term positions in the market. A short covering rally is certainly a possibility. Want to be careful if we get a short covering rally to be able to examine it closely, and you have to determine if it's just short covering, which, as you know, can weaken the market, or if it is short covering combined with new business. After a market has broken as extensively as this one has, what we will generally find is the market needs to find or come into short-term balance. Once that short-term balance is established, the market either continues on the original trend was up or returns to the current trend, which is now down. Until uncertainty is removed from this market, expect volatility to remain high. For the coming week, continue to observe if the market begins to seek balance. As of Friday's close, it has not done that. So the next phase now would be the market to come into short-term balance. Ideally, with short-term balance, the market would then turn back to the upside, or the market would form a short-term balance and then continue to the downside. Let me leave you with that and hope that you join us on Sunday morning, 11 a.m. Eastern, for our webinar, and we'll discuss questions in more depth. And welcome and have a great week.